and the US economy is outperforming the rest of the world, just as a fact, okay? And there's a lot of transparency, the Great Inflation Reduction Act, the whole fiscal thing. We're like 46% through that spending package. Like, we're not 86%. So I reckon the next 2 years, pretty well underwritten that, there'll be a little few hiccups, but we're going to grow at what we've been doing, which has been astonishing.
Hey everyone, welcome to a special in-person episode of the Julia La Roche Show. We are joined today by the Acid Capitalist Hugh Hendry, a former global macro hedge fund manager who ran Eclectica Asset Management from 2002 until 2017, which was a global macro fund that was pretty much uncorrelated to everything in the financial universe. Hugh, this is your third time on the show and our first time in person. I am so delighted to have you here today. Thank you so much for doing this.
I mean, just a pleasure. I mean, we're in Alphabet City. The last time I was, I think, round about here, I was in a club called Even Robots Have Souls.
Oh my gosh.
And I dropped my glasses and they had all that smoke. I remember being on my knees. So it was funny. It was like deja vu.
I think you're the only person that I would invite to like a podcast in the Lower East. Are we in the East Village? East Village. Yeah, no. East Village. So thank you for doing this again. I want to start where I always start with my guest, and that is to get your, updated big picture macro view, where we are today. It's been almost a year since I had you on last. And one of the things about this show is, take all the time you need to set the table.
Oh, really? Oh my God.
Yeah.
Well, you did ask. So I've been thinking a lot, as usual. I don't know where it comes from. And I put a paper out a week ago called the Obayashi Maru, which I'm not a Trekkie, but someone was telling me it was like from the second film, Star Trek, and the Captain Kirk is faced with a profound dilemma. He's got a no-win situation. And when I look at asset markets today, I feel that if I was the Federal Reserve, I'd be confronted like Captain Kirk with a no-win situation. So let me describe that.
Yeah.
And what I'm going to try and discuss, so like I'm a time investor. I'm not a value guy. I'm not a growth guy. I'm not a tech guy. I'm time. Time fascinates me. And so, and we'll go back in time to maybe try and have the audacity to see the future in time. And so there's kind of dates which will resonate perhaps in this conversation, which would be kind of 1927 to 1929. Would be 1980. I'm doing it chronological order, so we're not going back to the Roman Empire. It would be 1982 to 87. Soros called that what did he call it? The
Imperial something, right?
Imperial Circle, I think, yeah. And that was a time when the economic growth in the US, it took off. It took off because they took the straitjacket of Volcker's interest rates. We were at 16% on the 10-year, and they did some kind of good fiscal, and the US became the locomotive of economic growth globally. And again, I'm going to come back to that. That's very significant. The US is a choo-choo train. Might be causing might be about to cause chaos. Okay. And then we're going to go to 1998 and we're going to talk about currency devaluations out of the East. We had the sovereign debt crisis in Thailand et al. And I'm going to try and link that to the bubble in NASDAQ. And yeah, oh my God, and then we're going to get to now. So you did say a long time.
No, you can take all the time you need. Let's flesh this out more. We have all the time in the world. So
we got
let's go for it.
We got all the time.
Well, we have 90 minutes, but
so let's kind of dive in and out. So let's be present, okay? By hook or by crook, the US has become the economic locomotive in terms of global economic growth. It's rocking here just now. And it's rocking because I guess they found the right kind of gear for fiscal policy. And like people listen to that. Can I tell you, all you fiscally conservative people, you've held the world back for you've held the US back for the last 30 years. There is a profound tragedy in the policy era of fiscal conservatism. And then even when we splurged into like tax cuts, which were just like, there were just no grown-ups understanding. So I've been sending my monthly investment letters over that period you discussed, 2002 to 2015, my kind of formative years. And I had a family and everything went into the letter. You know, it was like a mousetrap. And with those letters and my mind, which is failing me, what am I saying about those letters? We were talking about...
So they were formative years for you.
They were formative years, and we were talking about economic growth. God, heavens.
You're talking about fiscal conservatism.
Fiscal conservatism. Anyway, let's kind of the fiscal conservatism that when they splurged, it was tax cuts. And now it's kind of targeted to bring the kind of the good manufacturing and the value added from the technology sector and to bring it home and create jobs in the US. And that's what I was actually trying to lead into those formative years. My life as a speculator was shaped and formed like every other speculator, and it was shaped by the ever-present, it sounds sinister, but the shadow of the rise of China. I want to say to you that we've had this incredible bull market, and truly incredible bull market in treasuries, and of course it's probably over. I just think there's always a little bit of suspense just before it dies. We'll see, and we've got all asset prices. Everything's expensive. Yeah. And like the ordinary folk are left behind.
Yeah.
I had people hitting me up yesterday because I was suggesting, how much do you speculate in terms of your wealth? And I was, typically your largest kind of component of wealth would be your house. And you would take away your mortgage, and that's your net wealth. Okay. And it's like, I'm saying to people, don't risk more than 10% of that number. And then today, so you always want to be invested, but today I wouldn't be more than 50% invested of that 10, which is to say only 5%. And kids are writing to me saying, screw you. Like, how am I going to move forward investing 5%? But of course, in the next line, he said, maybe that's why I lost all my money. So the sizing, like my tribe and my people, we dare to be bodacious. We dared actually to kind of anticipate the future. And that's a very, very risky endeavor. And if you overcommit, you don't make the completion of the journey.
Okay, so you said 10% of your net worth?
10%.
Invested.
Like, so say you had $1 million, your apartment is worth $1 million. You got $500,000 mortgage against it. So your wealth is like $500,000. And so I'm saying, like, if I'm buying Bitcoin and stocks and all that kind of funky stuff, 50,000.
Okay.
Whereas people come in and they put half a million, right? And the wind changes, and they get blown over. They can't hold it. It's like accumulate gently, wisely, softly, but accumulate. Don't just go all in. Now, if you're starting a hedge fund, it's kind of different. It's other people's money.
There you go.
And so if you're a kid and you're in your first year with a hedge fund, that's a different story, right? There, you're looking to be all in. You're trying to find the most volatile asset class in the world that's trending, that's positively trending higher. And then you just try and hold on to that. Because if you don't complete your first year as a hedge fund with 20%, like a big number, if you come in and you're like, I'm up 4% and my Sharpe ratio is really, really good. Yeah,
it doesn't work out so great. So I do want to get into your hedge fund years as well.
Yeah,
you have to have like a really good first year. Remind me, were you up 30% your first year, or was that during the crisis?
Yeah, the 2008, okay. I was 32 for the year. I made 50 October 2008.
Okay.
That was kind of funky.
Yeah.
But the first year, crikey, I didn't think I was going to make it because, when you're chasing the dragon, it's intense. But I made 50, and I made it from one of your friends from gold. Yeah, I was kind of one of the first of the new breed to come in and recognize that gold was set to go higher. But it was like investing in Bobby Digital. Do you know Bobby Digital? But Bobby Digital is what I call. I'm silly. I give asset classes names.
Okay, who is that?
It's Bitcoin.
Oh, Bitcoin. Okay.
Yeah, is Bobby Digital because gold is not digital.
Yeah.
Anyway, but back in 2002, 2003, gold was like Bobby Digital. It was insanely volatile, and I was buying it, and the Chancellor of the British Exchequer was selling it. And again, so my big thing is irony and paradox. For over 200 years, if certainly longer, the Bank of England, it was infamous for the great stash of gold that it has under the streets of London. And it accumulated through, we didn't have famines in the UK. We did have it in Ireland, but war and political upheaval. And they saw the centrality and the need to have these gold reserves. But as you know, gold had a torrid time between 1980 and 2002. It lost 2/3 of its value at a point in time when the stock market probably rose 8-9 times. And right at the worst moment, the Bank of England said, "Yeah, let's sell it." They sold like, did they sell all? They sold a lot. They bought it, and I bought it, But there were moments in that year where I was down like 15% in a month, and I'm thinking, I'm like hedge funds are like restaurants.
Yeah.
The failure rate is intense, and likewise, the return to the survivor can be really good. For hedge funds, it's really, really good. So I got 50, and because of that, I had some goodwill, and that gave me 15 glorious years to pursue curiosity.
Yeah, let me ask you this, because in our prior conversations, we've kind of revisited your past, and sometimes the conversations would get a little vulnerable, but I really appreciate that about you. So my question is, I imagine you probably loved running money at some point, and did you find that you lost the joy in running the fund? What kind of happened, or did it become joyless?
Oh, at the end, certainly it was joyless. It's an interesting question. I'm releasing my book, plug.
Okay, well, we'll have you on when the book comes out too.
Maybe August, September. Gonzo Finance. Money and other people's money, it's little c, it's little conservative thinking. And we talked about my notable successes, and that has to be prefaced with the fact that I made, if I made money, I made it in the out years. I think you were suggesting I was uncorrelated. So that was, and people don't understand this, you didn't beat S&P, but I was meant to be antimatter versus the S&P. If the S&P, the worst month in the history of the S&P, October 2008, I made 50%. That's called orthogonal and not being correlated. And the challenge, and so it's like a fire insurance, and I compounded it a measly 7 or 8%. People are like, oh my God, that's so boring. But actually, if you think about it, I was a fire insurance, and rather than you sending me your annual premium, I was actually paying you $7 every year, or $700 every year for that insurance. So you got the insurance in case things went bad. So, which is to say, I ran positive carry, but yeah. And if we're on that, because we get new folk coming in, and I always see the comment. I read the comments. I'm reading. I'm watching you people. And the one that is just so lame. Please don't make this mistake. You can't confuse assets under management, right, with performance, right? So at my peak, I had $1.5 billion. In the hedge fund, I had maybe $560 million back in 2012, 2013. And you know what? In 2017, there was none left, right? That doesn't mean I lost, half a yard, $500 million. It means I was a bank, and I was like, you want your money back? Boom. An honor to have served as a custodian with your trust. Boom. And there's your money back. So AUM, people, okay, I know it's complicated. AUM is not performance, right? I didn't lose I didn't lose money. I didn't lose extreme. A bad year would be like 2 or 3% kind of thing. So anyway, I go through those notable highlights, and I get to March 2009, and all the money gets pulled again from me. I'm down to like 45 million. And you can't run a business like that. And some kind of suits approached me and they're like, do you want to manage like a lot of money? And I was like, yeah, that sounds cool, you know. And like, well, we're going to make a few changes. And the principal change was they had to take like this kind of crazy idiot person that you see, and they had to put me in a dungeon. And I mean, I look like I'm dressed for a dungeon actually, but they had to hide me in the dungeon. And they insisted that I hire a new breed of like expert specialists. They were nice kids, but lots of people. They insisted I couldn't do TV and media. They insisted I couldn't really speak to the clients.
You're kind of like known for that. You would go on like the BBC and stuff.
Yeah. No, indeed. But I had no AUM, assets under management. And so I agreed to it, and they were true to their word. I got to like $1.5, $1.6 billion. And I wore a suit. If you see pictures of me 10 years ago, I want to say I look 10 years older than I am now. I
remember that. I went to like a conference, I think it was The Economist, and you were one of the keynotes with your suit and your glasses. Okay, if this is wrong, we'll cut it out of the episode because it might be like a fever dream for me. I remember, it would have been like 2011, around that time. Did you have like YouTube videos of you in China?
Yeah.
Okay. I do remember that.
And again, that's very symptomatic because they were cool. But the suits.
Yeah, you were showing like the ghost cities or something.
I mean, I was so wrong, but let's move on.
Okay.
No, because that's good as well. Because it's China, and China will keep coming back to. And actually, that was 2009. But in 2011,
I saw them in 2011.
My suits then took it off the YouTube. They're like, we don't do that stuff. We're serious. This is how. So to manage a lot of money, you have to be serious, and so it's a kind of tale of two cities. I was financially being like incredibly remunerated. I remember sitting, as you do, Cheval Blanc. Actually, it was called not Ile de Ré, but it was called something else back then in St. Bart's. And I'm there with my CEO and his family. He had 3 kids. I was there with my family, 3 kids, the nannies. It was a big posse. And back then, we're still getting faxes, and it was a fax, and it was a client, and they were putting $150 million, and like that. Today, that's not a huge number, but believe me, I was used to getting like $1 million, and the staff are bringing all the paper, and my ex-wife, she was like a head counsel of the business, so they're all working and they're really ecstatic and happy, and I was just slumped. I was like, oh my God! And what was my problem to get there? They took this crazy person away. And my investment letters became like a digital series of like X01. I had nothing. I had a year on antidepressants, which made me sleep well, but I was a zombie. And then thankfully, I ripped the Band-Aid off. I'm like, Jack's back. Mm-hmm. So yeah, you wanted to keep it real, and mental health and lessons learned. You got to be who you are. Yeah. The money ain't worth it.
Hey there. I hope that you are enjoying this interview. If you can, please take a moment to hit the like button, subscribe to the channel, and ring the notification bell. This will keep you up to date with all of our new interviews, and it will also help us grow this channel and continue to bring some amazing guests. Thank you so much for your support, and enjoy the rest of the interview. Would you ever want to go back and do it again, or do it differently, or
we all want to do it differently,
or even do it now?
Do it now? No.
What if you were starting out today, like that young fund manager? I think you're probably early 30s when you started, or?
Well, I got the hedge fund. I think I was 32, and it's one of my repertoire stories that I was walking in beautiful gardens in Lugano, by Lake Lugano, with this Italian patriarch who had been the seed investor of George Soros. And he was saying to me, there are only 2 problems that I have. He wanted to seed me. which was just an amazing honor. And he said to me, my age. People forget that George was 40. He began in 1969, I think, with the Quantum Fund. And he's like, yeah, like you're still young. And there's something about having overcome a lot of obstacles in life. It makes you a risk manager and it sets you up to start charging to be a risk manager, to be a hedge fund manager. And then the other thing he said was that I spoke too well. And like all the money managers are like mute. I mean, if you go to some of these conferences, they're just reading out prepared texts, you know.
That's boring.
It's boring, but what are we talking about? We're talking about the boring people succeed in this business. You know, they succeed in the asset gathering business. But what I really miss, so I'm not a trader. I'm a storyteller. Yeah. And I kind of see things. I keep saying, I've been talking a lot this week about being a paranoid schizophrenic, which is to say, I really like the rhythm of music, and I would be very detached from my team, and I would watch charts and chart formations across all asset classes and all markets, and I'd be listening to Pink Floyd and what have you, and I'd begin to associate patterns, and that would generate a curiosity in my mind. So things they'd been going nowhere forever, and then they'd beginning to rise. Now they'd be rise. I was looking at relative price charts, and it's another, if I have any wisdoms, stocks go right or they go wrong relative to their peer group or like the stock market before like the explosive absolute movements. So I was very tapped into that. And as I was able to conceive and see the names of the companies and then the industries, and then you work back and you ask questions, why is this happening? And then I had, and then I employed like really serious, smart, very intelligent people, but I would take an investment in these businesses small, and I'd confront them and I'd say, I'm crazy. And indeed, I'm getting paranoid because I've just bought these stocks based on listening to Pink Floyd and looking at their charts going up. But you confirm or take me on. And so there was a synthesis of the conventional and very thorough like research, but I was the source code for kind of vibing with the future. And so to do it again, the one thing I missed, and no disrespect for the people that work with me, but I really missed like a trader, like someone who just is an intrinsic moneymaker. I've got a great buddy in St. Bart's, and he's retired, and he just sits every day. And the money he makes is insane, insane. So like if I was to hook up with him, I could conceive of something. We were looking at doing an ETF. I don't want to be that guy. I don't know.
I don't know. You could do like an acid for the ticker symbol. Could be pretty cool.
I know it's taken just now, but it apparently it's going to become available again. So.
Oh, okay. Well, there. Ooh.
I just want to sing and play piano.
But you've never done acid while watching charts or looking at charts.
No. Tracy was Tracy on.
He got asked that on a podcast. Just so you know.
Another wise person was saying to me that you got to lean into your audience, that they actually tell you who they want you to be, and like you should be that. Like you should be. What's your objective? Your objective is to be liked and to spread the message and like whatever monetization. And so you've got to accentuate what they're telling you. So they all want me to be a little bit kind of acid, But I love my brain. I'm really, really attached. I love the word generation, and so I don't like the distortions. I don't like bringing like invaders into my mind and like because my home team are like, who the hell are you? Like we've got a good DJ set already here. It's not appreciated, and then they all start fighting, and it's a mess. So I don't like the acid. I don't like, but I really like the mushrooms. For me, that just accentuates who I am. And I swear, I'm terrified of dementia. I'm sure I'm partying really hard just now because I'm sure I'm going to die prematurely, but I'm just pessimistic, I hope.
I hope so too. That would be terrible. So looking at charts, listening to music, vibing, are you looking at charts today and catching any vibes? Like what is, interesting to you or standing out?
Yeah. Well, I mean, that's the weirdest thing because you were saying how at the end it was joyless, and I felt I'd done a lot of I'd suffered lots of mental anguish. I continue to, but that's why I went to St. Bart's. There's a notion of like, there's something about like looking at natural beauty and how actually it heals a lot of the tumult in the head. And I needed that, because the being orthogonal, not being the person that correlates, most 99.9% of managers have beta. Markets go up and they go up every year, and you just got to turn up and they go up. That wasn't my gig. And now the dialogue in my head was, I'm going to die. I'm going to die. I felt like Mortal Kombat, especially going through 2008, short selling bans and all the filthy things they did to kind of try and obfuscate, the great problem back then. There were profoundly dark days. So the brain has, there are no windows. The brain doesn't see out. It's reliant on idiots like me to give it feedback. And I'm like, I'm going to die. I'm going to die. And so it floods you with chemicals, fight or flight type things. And they help in moderation, but if you're getting flooded with all the time, that's toxic. So that's why I kind of embraced St. Bart's and no, Bloomberg terminals, price terminals and the like, and just try to unhook from the matrix. But I don't know where it comes from. It blows in the wind. The future kind of finds me and it whispers to me. So what am I seeing today? So again, paramount to everything I want to say is China. The Chinese Communist Party and the way they plan the remarkable rise of the Chinese economy, they are aligned to Wall Street. And Wall Street's where the money is, and Wall Street controls kind of Washington. And it's this circle which keeps out like the plebs, like the ordinary people. So the rise and the rise and the rise of China has been truly extraordinary. They've come from nothing, and they're bigger than Europe today. And economics is all about the exploration of equilibrium. And sometimes many times you're starting from disequilibrium. And the fascination is what happens next. Because it's kind of like if you're in disequilibrium, there's a form of economic gravity. And it should, if it's well designed, the economic gravity pulls you to the center and it moderates. And it's like an anti-fragile system. Economic gravity brings you to the center and it takes away the wings. That's not happened. And the principal function is that China decided to, China's having the US moment from the 19th century and into the early 20th century, the industrialization cycle. And the US industrial cycle was funded by overseas creditors, principally the UK. They had large savings and nothing to do with it. Like in the US, like I want to build canals, I want to build like train lines, etc. And that was all funded. So the US ran a deficit in terms of capital coming in, but then it had a trade surplus on the other side. And that is a dope system, really, really good. Now, don't get me wrong, it has vicissitudes, like, because we're all entrepreneurs, we all get, too optimistic, too pessimistic. And so, there would be manias and panics, canal panics, railway panics, great crashes. But despite all that volatility, like London bankers and London creditors, they made out like bandits. But the Chinese decided they didn't, because they're communist, and they didn't want to take the knee, like, to Uncle Sam. So that we're going to do it ourselves. And so that has like a profound difference. And you've heard of this thing called the Triffin dilemma, which is all about as a sovereign, there's three things. There's your current independent monetary policy, the level of your currency, and edges of grey around it. And China subjugated a lot of it. It's just like, we're closing our capital account, so we don't want to be dependent on foreign capital because they could bring us down. And we're the Chinese Communist Party, and we must live forever. Okay, they're like Dracula. And we're going to target an exchange rate, and we're going to keep our exchange rate kind of low and really, really competitive. And we're just going to be the biggest surplus nation in the world. And that's worked for them. It's worked for, again, the Communist Party, and it's worked in terms of GDP growth. But it's not worked it's worked, but it hasn't worked for the ordinary people. Okay, so and there's subterfuge. So because again, people are like, what are you talking about? Like Chinese people are richer than they've ever been. Okay, acknowledged, right? So what does that mean? Their father, their grandfather, like were on 50 cents a day, and they were tilling like non-fertile land. Okay, so they earn nothing. And then over the course of the last 30 years, we bring them into Shanghai and elsewhere, all these incredible, huge cities, and we get them to work in a semiconductor fab. Okay, their productivity has just gone up a zillion times, and you pay them like 100 times what their fathers earned, so they kind of feel rich, but they should be richer. It's the bit it's the gap, it's the bit we're missing, and the manifestation of that is the Chinese currency should have risen. The currency is the reward for doing things smart, doing it wisely, and it's part of the economic gravity that I'm trying to allude to. So 1994, there's another date, but that was the year of any idea? 1994, okay, I'll tell you. NAFTA.
Okay.
NAFTA is with the North American Free Trade Agreement with Canada and Mexico and the United States. And remember, the Chinese, what did they do? They want to own global trade. So they're like, oh, we don't like this. We don't like this. And so they took a very defensive measure and they devalued their currency. Again, we want to be number one in exports. And they devalued to 6.3. Now, their currency is called the renminbi. Again, I've talked about Bitcoin, Bobby Digital. So the renminbi, let's call it red cabbage. So back then, you needed six and a third of a red cabbage to buy $1. Right? Okay. What do you think you need today? How many cabbages?
To buy $1.
Okay, I'm going to.
I don't know. You tell me. Yeah,
you need 7 and a third. So you need more cabbages to buy $1. I was going to go higher. So yeah. You need more cabbages, which is to say they're poorer. They got to work harder. They need to buy another cabbage before they can buy $1. That makes no sense. Okay, and the way they've done that has been to take all their surplus money and buy US treasuries, buy risk-free securities. And in the US hasn't needed it because, what did I say earlier? They've been fiscally conservative. So what I want to say there is, so let's go into the 21st century. We know factually, sovereign nations and creditors from outside America, they put $7 trillion. That's like a third of US GDP. They put it into risk-free. They wanted to buy treasury bills. Okay. But here's the rub. US Treasury issued less than $1 trillion. Yeah. Okay. So, and the bankers on Wall Street, like they're smart, you know. And so there's this huge demand. Offshore wants to come into the US, and Uncle Sam's not producing it because it's like, oh, we're fiscally conservative. Yeah. And so Wall Street then said, oh, let's create a synthetic risk-free security so that we can sell it to Johnny Foreigner. And that was the advent for mortgage-backed securities. Remember the whole idea, if you take a nationwide distributed portfolio of mortgages, people never want to default on their mortgage, and we've never had a nationwide synchronous decline in house prices. So when you put those two ingredients together, it was like alchemy. It was like, wow, these are actually less risky than US treasuries. Yeah. And so they sold $7 trillion of that stuff. Where did that go? Let me tell you where that did not go. That did not go into building like bridges that don't fall down when errant ships hit them. It didn't go into like the fastest high speed like rail tracks. It didn't go into the upgrade of the airports. It didn't go into like tackling the chronic failure in the education system or the healthcare system. It didn't go into infrastructure. It didn't go into like free Wi-Fi everywhere. Where did it go? It went into a speculative housing bubble. Yeah. So a lot of money parked overseas, people managing their exchange rate have to put money into the US. US wasn't accepting, the government wasn't accepting the generosity. And so it was big leakage into the private sector, and it's fed asset bubbles, right? And so the interesting juxtaposition is, you don't need me to tell you, like China's kind of like is struggling. You know, their GDP calculated like, it's not working, it's not working. And they're really tapped out on exports. Like they're enormous. Their share of, their surplus as a percentage of global GDP is something like 1.5%. We've got like 150 years of data, and no one, you're on the the roof, you're on the ceiling, really hard to break through. Why is it really hard to break through? Because you're killing indigenous industries. So just now with the EV, the Chinese are just about to wipe out the European car sector. Okay. So the question is, if I'm a European politician, am I going to allow that? Probably not. So we're getting into, again, let's go back in time, 1930 and kind of tariffs. And we've already had Trump, and it's like putting up walls. Mm-hmm. So one of the big issues is, what if that China thing has tapered off? What if actually it's Marxism? They found a kind of permanent plateau, but a plateau, and the plateau will stop producing the liquidity. Let's think of Fantasia, the Mickey Mouse. And,
the movie.
And the wizard goes to sleep, and he's got to clean up the castle, and he gets the notions and the potions, and he gets the broomsticks.
Yep,
to clean. Right, yep. What do? They've got to fill up buckets. So think of that is as the sovereign mercantilist nations, and they're coming with all this liquidity, right? And then they're dipping it into the US. But the Fantasia, it goes crazy, and there's more, and there's more, and there's more.
It's flooding,
That's been our world, and that's a world that created a bubble in NASDAQ in 2000. It created a bubble in US housing in 2006, 2007. Arguably, it's creating a bubble all around us today.
Yeah, what's the bubble today?
What's the bubble today?
Yeah, tell me, what's the bubble today?
What's the bubble today?
Yeah, tell me.
The bubble today is just the fragility of valuations. We're curious about observation points. We're curious about, I'm hesitating to say this, but we're curious about bell curve distributions, right? Not because they're smart, but they elucidate rare events, right? So, you know the bell curve, right?
Yes.
And the absolute line share of the area under the curve is captured within 2 standard deviations of the mean, right? And then beyond that are your tails. And the percentage of the area underneath the tail, if you will, is tiny, right? So I'm kind of like a 4 standard deviation person. I'm not gloating. I mean, like, that could be good or bad. I'm 4 standard, like, there are not many people like me. Yeah. And there are not many observation points where the total value of equities divided by the stock market is as high as it is today. And so we call them, that's kind of rare. And when you get rarity, you've got to kind of sit back and go, and you study it. And so you go back and say, well, what happened? What happened next? And like, good things don't happen because you typically get mean reversion. So the bubble, we're in the bubble and everything.
Okay. Bubble and everything. So going back to the top of the conversation, we were talking about like 10% of your net worth invested. Like, how much of that 10% do you want allocated? How much of it do you want even allocated to stocks? I know you mentioned Bitcoin, Bobby Digital earlier. Okay.
Bobby.
Can we talk about like just the allocation? Walk us through that right now.
Let's do gold and Bitcoin. Let's do gold and Bitcoin. Let's try and put a portfolio together. Gold has convincingly broken out of an 11-year, gold, is it not Goldilocks, but a nap. It's been napping. And it does that. It's, and again, that's when I talked about music and chart formations, that was the thing that always lit me up. I always say that I was kind of traipsing. What is traipsing? I was dancing through graveyards. It's kind of personal, morbid. But I was always fascinated by stocks and asset classes that had like lit up the sky like a firework, and then inevitably had like fallen back down. And when you fall down and you lose money for people, like there's disgust and contempt, and people are like, I'm never going to talk to that girl again, kind of thing, or that guy, whatever. And so I always like just looking. It's like, I guess Warren Buffett, Ben Graham, whatever. It was like the cigarette butts.
Yeah.
So I'm always looking, I'm a midnight rambler. I'm looking for a cigarette butt in the graveyard of despondent souls.
On the smoky floor of a club in the East Village.
Oh, yeah. I've got another story, but anyway. And so the caricature of that from an absolute or a relative price point of view is something which has had this watershed moment, and it's lost 80% of its value. And I promise you, it's such a common chart formation. They then go sideways for 10 or 15 years in a very, very low range, because like people just don't want to know about it. And some of them come back to life. They get new management, something in the economy changes, they get a new technology, and no one wants to know about it. And so they start to rise. And you can get you can get in really early. And what they do is they make like a 5-year new high. They make a 15-year new high. And it still means nothing vis-a-vis like the top share price. But the market, the wisdom, you know, they say when you're stuck, call a friend. So that's what I'm doing, calling a friend. And the market reveals, you know, one of my big things is, and the error of a lot of people is what I call the conceit and the arrogance of a well-formed argument. They will buy on the basis of the narrative that they've conceived. And they're like, oh, I'm just buying it. You got to wait until the market is beginning to have a sense that begins to confirm your narrative. You need strangers to confirm your narrative. Yeah. And then you come in and you buy it. Okay. And what I'm saying is I typically will buy even not aware of the narrative, but I'm just very respectful. The market's going, something's happening. Something very positive is happening. I had my portfolio in 2005, I was buying like lots of shovel companies, if you will, like into the commodity sector, into the oil sector, oil and gas sector. I remember buying a pumps and valves business, actually located in Scotland. And that was classic. It had a hiatus for, I think, 15 years, and it started to make a new high. So what did I say to you? Is I buy a little bit, and I went to like my equity guy, the smartest equity guy on the planet. I was like, dude, like what's happening here? And so he tore it apart, spreadsheets, you know, met the company, and he's like, I can't make it work. So the valuation metric that we use back then and today, kind of shorthand, is there's only 3 things I need. I need the chart. 4 things. I need the chart. I need the enterprise value. So that's the market capitalization plus the debt, and then minus the cash balances. And if you really want to be cute, because cash balances could be inflated at the year end. So what you do is you go to the cash flow statement and you actually take the interest that they paid and you take that as a percentage of the debt. And if it doesn't make sense, you're like, oh, they're cheating on them. So, you know, anyway, so enterprise value. And you divide it by sales. So these guys, okay, let me start again. The chart,
okay,
the enterprise value, which I defined, the enterprise value to sales metric. And then I'd want to know the last 10-year EBIT margins, profit margins. I want to know the mean and where we are with profit margins. And as a rough rule of thumb, if it's a kind of mature, like pumps and valves, it's not AI, okay, then you would typically be looking to pay one-time sales for a kind of well-managed manufacturer doing 7 or 8% EBIT margins. And so back then, these guys were on like 1.5, 1.6, 1.7. So it was like really, it was expensive. So my guys, like we're in it to win it. How can we make 4 times the money with this thing? And I was like, okay, let me think about it. I was like, we're going to make 4 times, buy more. And it quadrupled. And why I was on it. I could see the oil price. And I was like, oil's going higher, baby, you know? And the analysts, when they were plugging it into their models, they're on look back. So I'm on looking into the future and they're on look back. And I said to my guy, you know, what if you type in like $120 oil price? He was like, it's really cheap. I'm like, there you go, baby.
There you
so
go.
that's a bit of acid capitalism.
Interesting. Okay. So we've talked about like the arrogance and conceit of a well-formed argument. Oh. Can you just quickly explain that for folks, that concept? And yeah, let's just start there.
I mean, there's a lot of really intelligent people. Like, you don't impress me by being intelligent, right? Like, there's 6 a dozen in Wall Street, in London, etc. Right? That's just the minimum entry level. when I started off in 2002, I didn't know what a hedge fund was.
I didn't know what a hedge fund was when I started as a hedge fund reporter.
Yeah.
Yeah.
And then I dug in, and, the incentive scheme is dope. You get paid a lot of money if you make it. And so you got to, and it's, what are you doing? You're endeavoring to apply intellectual capital. So I conceived it as being the highest return on intellectual capital of any activity in the world. And therefore is kind of perhaps logical deduction that amongst the smartest people on earth are going to be drawn to the thing that has the highest return. And I'm really proud of myself that I had the wisdom to say, it's not a good idea to try and outsmart the smartest people on the planet. I'm guaranteed to fail. And that's why I reverse engineered, and I said to myself, why is it that really smart people are not guaranteed? And isn't that beautiful? You're not guaranteed to make money because your folks were rich and they sent you to like an Ivy League, and then like they got you contacts and they got you into an investment bank. You know what? Good luck. You got a lot of assistance there, but try and make money with it because it's not that easy. Mm-hmm. It's not just the mind, and so that's where you come into the arrogant and the conceit. For sure, with logical minds, they can come up with a great idea.
Oh yeah.
But the market ain't your friend. I keep talking about the. I love saying this, the bucking broncos. That's what we call it, isn't it?
Yeah, in a rodeo.
The market's a bucking bronco. And the conceit and the arrogance is you've got your spreadsheet, and you've channel checked, you've met the company management, you've made a presentation, and everyone's going, yeah, no, like with the EBIT margins this and da. And you sit on the bucking bronco and you're like, yeah, I'm writing this. I'm going to make money. But the market's like, you think you're going to make money, my friend? And it starts like rocking. You get thrown off. Why'd you get thrown off? Because you committed to it at the wrong point.
Yeah.
The example I always give is I bought into the, I don't know if I bought the IPO or shortly after the IPO of, Reader's Digest. And Reader's Digest was a compendium. It was like, I was sure that Warren Buffett was going to buy it. I was an idiot, but so you had the world's largest publication, and the source material was old news, mm-hmm. which is it was free, but they packaged it together, and you go to the dentist before the internet, and it was something to read, and it would be a compendium of all the news articles, and it'd always been a private company. But it floated in the 1990s, and so I thought they had these enormous. I did all the Warren Buffett thing. I was like, this is Coca-Cola in publication, and I bought on behalf of the pension fund manager I was working for. I was responsible for partly responsible for US equities at the age of like 23 or something. Now the IPO, and so the flag here, the first day trading was lower, not higher. Not a good sign.
No.
And I came in, I think I was buying it 3 months later, like way below the IPO price. People don't do that. It was really, really dumb. I was arrogant. I had conceit. I'm like, I've seen the future. Reader's Digest. Warren Buffett's going to buy it. I buy some. It goes down more. I buy more. It goes down more. I buy more. And the partners are like, kid, tell me the story again. Tell me that story. I went to visit them. Took the train there just outside New York, place called, is it Paradise? Eventually they tapped me on the shoulder and like, sell. And thank God,
yes.
It went bankrupt.
Wow. Is it hard to admit in the business when you're wrong? Or I don't know if that's a good question, but is it hard for folks? It's a great
question.
Yeah.
And when I interview people or I'm trying to determine like where I am with someone's skill set, that's my question. Tell me when you know it's going wrong. That's my number one question.
Okay.
I want people to have thought about that. And so for me, this is a precarious and a preposterous business in guessing the future, right? Guess what? You're going to be long. You're going to be long and wrong a lot of times. And so again, being cute with language, I would have clients come from all over the world to see me in London, and I'd be like, I'm a world-class loser. Yeah. And And they didn't get it. It's like throwing a cherry bomb, I guess, but they didn't get it. And what I was saying is, I go into the equation with the absolute, not determination, but expectation that I'm going to be wrong. Because I typically buy the things which are not expected to. I buy payouts on things which are not expected. I don't buy everything, but I kind of work on my angles, and I'm coming in and buying things where the expectation is I'll lose money. So being wrong, I'm supposed to be wrong. So the penalty for being wrong in that situation, kind of modest. You die another day. It's just boring. It's like a little nick on this little cut on your arm. Well, you had a lot of nicks, but you can move on with them. So practice being a loser, because if you can tolerate and survive your losing trades, then the future is golden, my dear child.
It's a good lesson. Okay, so going back to the topic of gold, which happens to be very popular on this channel with folks who watch and listen. Also silver. They always ask me to ask about silver, and I always forget. So maybe you can throw that in there too. What's going on? Like we were talking about gold. Do you own gold right now? Do you want to keep owning it? Do you think it's going to go higher? Like what is driving it? Is it just central banks? How about the retail investors? Like you once called it stupid on my podcast and preposterous. So
it is stupid, and I'm going to be this is like.
But you own it, right?
Kind of. I intellectually own it. Okay, many questions there. Let's do rapid fire. Why did it break out of an 11-year price trend?
Yeah.
It's not an agent of chaos. It's the alchemy of chaos. When the world becomes chaotic, I think our world is really, we might have a friggin' invasion of Taiwan. We've got the Russians. We've got, the whole Israeli situation. Presently, the US is cutting back on their supply of military, like the US and Israel are at loggerheads. The war's complicated. We've got like two people who've got one foot in the grave running to be president of America. We've got I've got jokers to the left of me, clowns to the right. Every politician in the world's a joke. Chaotic. Gold is alchemy at that point, because it transforms the chaos into price gains, and that's what we're seeing just now. Now, the prince. So that's that. Second point would be why now? Japanese yen has devalued by 40%, almost 40%, and it actually doesn't show. It doesn't look as if it's got breaks. They're tapping just now. Why it took them so long, but they're tapping. They're doing some intervention. But I think they're powerless. I mentioned to you the Obayashi Maru no-win situation. We're going to come back there. So gold seeing that. And what is happening to the yen should not be happening, right? So the plumbing, the euro-dollar system, the way money and credit is created is such a complex. It's beyond the capability of central banks. They gave up a long time ago. It's got nothing to do with banks giving you a car loan. It's just a tiny component of it. It's way different. And this explosive, this is almost a forced standard deviation. I want to say I'm going to call it a forced standard deviation. Like 40% deval in the yen is telling you that something under the surface is really, really bad. Really, really bad. And so that's what gold is picking up on. Now, gold and Bitcoin, Bobby, I like to reduce it to simplicity. I'm not going to give you I could not possibly discuss blockchain and whatever. And I don't have a digital wallet, etc. But I look at it simply that Bitcoin has been accepted by a new generation as a form of gold. They're both residents in a house that we call alternative assets. They're alternatives to investing in stocks and equities. And that house, in terms of all the other people who live in the house, who else lives in that house? Private equity, index-linked government bonds, commercial property. Right? So it's like $100 trillion, more than $100 trillion house in terms of the total capitalization of it. And gold going to make this number up, but I want to say gold today is about, the total value of gold is about $17 trillion. Okay. Total value of Bitcoin, I'm not talking about, shitty coins and stuff. I'm talking about Bitcoin, and I'm assuming you get to the logical 21.5 million coins minted, is less than 2 trillion. So it's less than 2 trillion. And I know that the largest investors in the world, they have to invest in this box called 100 trillion. And like 2 could become 4, could become 8, become 16. A lot easier than gold can become 34 and $68 trillion. I mean, I've seen a lot of crazy stuff, and even I struggle to think that gold could be capitalized at, it's not inconceivable. The global GDP is $100 trillion. If gold tripled, it would be, its capitalization would be 2/3 of global GDP. I'm going to go back and I'm going to look for episodes at the peaks previously. But Bitcoin is a breeze. Bitcoin is a breeze. It easily doubles.
Yeah.
And then the other thing, which is really cute, took me, because I'm too busy partying and stuff, but it took me a while to figure it out. But the halving, not the haves and the have-nots.
No, I know what you
there's
mean.
an L in there, the halving. That's pretty damn cool, because so let's do gold. We're in a bull market. We love it. Price is going up, right? Oh, wow. Okay. What's happening? Like the gold mining guys, what are they doing? They're getting the picks and shovels, and they're like, go faster. They're producing more. The higher the price of gold goes up, you're going to get not an avalanche, but the amount of new gold coming onto the market is going to rise. It's going to rise a lot. Whereas with the halving, as the price goes up, they're like, we're actually slowing down the production. And that's kind of really damn cool. It's a pity, like they should impose halving on gold, but they can't. So that's interesting. So I think I would own both, but I really should be really overweight Bitcoin vis-a-vis gold. And then if you come back into the gold thing, and this way, so you said there's a lot of silver people, like,
yeah, I always forget to ask about it, and then I get called out in the comments.
What's going on? Okay, they are masochists. They how can you sit and just not make money for such a long, like forever? But they're in love. Silver for them. I mean, I could give you the profile of the girls that I like, but I won't. That would be inappropriate. But they've clearly, silver's their girls, and they are just in love, and they're going to the grave with silver. Periodically it flares. When it flares and it goes up, sell it. It's so bad. And then gold, it's the same thing. The affliction. It really upset. To be honest, they upset me. Their receivers are just not on. So many. It's the conceit, the arrogance. They've come to an understanding, and nothing will persuade them that they're wrong. Like the price going down, like losing money for 15 years. I don't care. I'm right. You know what? There's a point where you're not right. You get timed out. So what I'm talking about is the idea of investing in a gold mine rather than in gold is the dumbest thing conceivable. Okay. And I say that with authority. We've had ETFs in the minors, and I'm going to do the majors, wait till we get to the juniors. But the minors, I think from 2004, an investment in the biggest mining ETF, you're down about 9% since 2004. Okay, you're up 500% in gold. Okay, you're timed out. It's the wrong play. And then, so what I used to do, gold miners have volatility, which is say the price doesn't move 1 or 2%, it moves like 15%. Yeah. And we conceive of that as being risky in markets. And if something's if it's vibrating so wildly, then you have to kind of moderate your position size. Again, otherwise it's the bronking bongo.
The bucking bronco.
It's a bucking bronco. Silver's a bucking bronco, and gold miners are bucking broncos. And so you moderate, you strap in, And so what you can do is you can say, okay, well, maybe I don't have that much money. And I feel like, yeah, the gold miners are more volatile, but when they move, boy, do they move. That's the nature of their volatility. But you can answer that today by just owning gold, but volatility adjusting that. So what I mean by that, if you're going to put $10,000 into a gold mining ETF, right? Instead, I put $30,000 into the XAU or the GLD something, into the miner. Then I've replicated and I'm on the winning side. I mean, I can say that a million times. That it's the Warren Buffett story. I mean, this encapsulates it perfectly. The oil tycoon dies, and he's at the pearly gates having a cigarette with St. Peter, and he's like, "Hey, what's going on, brother?" And he's like, "Wow, like you're in the oil section. I don't know what to tell you, but like you got to sit on the bench. Like we've had a spate of deaths from your sector, right?" And this guy's like billionaire. He's always had doors open. You're like, oh, really? What? Purgatory? Purgatory? And he's very charming. He's probably Texan, and Texans are always very, very charming. And so he says to St. Peter, "Hey, listen, mate, he's got the cigarette. He's like, you just one request, my dear. Can I just say hi to the guys?" St. Peter's like, "This guy's a pain in the ass." He's like, yeah. And so he puts his head around the gate and he says, "Oil found in hell." Yeah. And you can imagine what happens. There's a stampede from heaven to hell. This is the greatest metaphor for investing ever. And so St. Peter's like, "Well, I seem to have vacancy." And the guy, he puts one step into heaven and he pauses and he turns back and he says, "You know what? There may be some truth in that rumor. After all, if you're invested in silver, if you're invested in mining stocks, if you're investing in junior mining stocks, I've just described you."
You love metaphors. I want to go back to what we talked about at the very beginning of the conversation when we were talking about like the macro. And one of the things I picked up on was you were talking about the Federal Reserve is in a no-win situation. Fed Chair Powell spoke last week with the FOMC, said he doesn't see the stag or the deflation. I want to get your take there, but what's the no-win situation?
The no-win situation, I'm glad you've imposed order. So remember, I've been saying the US is the economic locomotive of global GDP, and how I believe our system wasn't conceived to operate that way because the US is also the issuer of the collateral that creates global money, which is treasury bills. And the COVID and then the pivot to smart fiscal, whatever, it's working. And the US economy is outperforming the rest of the world, just as a fact, okay? And there's a lot of transparency, the Great Inflation Reduction Act, the whole fiscal thing. We're like 46% through that spending package. Like we're not 86%. So I reckon the next 2 years, pretty well underwritten that, there'll be a little few hiccups, but we're going to grow at what we've been doing, which has been astonishing. And of course, we insulated the private sector, the household sector, by everyone refinancing back during the COVID at really low rates. So everyone's carry on their liabilities, unless it's your credit card, but your mortgage liability, if you're staying put, you're safe and secure. So the economy's humming. So the Fed's at 5.5%, ECB's at 4%, Japan's at 0%, and China's kind of like a 0%, but it makes it up. UK's at 5.25%. And everywhere outside America is like the economy is shuddering. They've got issues, like they don't have the growth rates. And again, you've had this currency eruption in one of the most important crosses, the dollar yen, which is telling you that we're like something is really close to breaking, like really breaking. And we definitely know that central bankers and treasury ministers are talking a lot more, and we know that the dollar's been rising. And the Fed has kind of bad form on this. So the Fed is, the only thing the Fed is, it's the regulator of the domestic bank, US banking system. And its only objective is a domestic objective, for kind of full employment, low inflation. But there are times in the past when they've been persuaded to subjugate that primary focus to kind of help the rest of the world. And every time they've done it is bred profound chaos and disruption in asset markets. And again, we were talking about why is gold moving? Gold's got a sense of this. The Japanese are pretending that they can raise interest rates, well, like to protect their currency, because like selling dollars and buying yen is not going to fix it. It's all about credibility in sovereign currency markets, and the Japanese cannot raise interest rates. So they've had, like JGBs, the Widowmaker, and 10-year securities have been yielding nothing for like the longest time, and yet 1/3 of the total government revenue in Japan goes to the service and the accommodation of their debt. That's zero rates. Their appropriation of their government revenue to service debt is almost on a par with the US at 5.5%. So Japanese, it's like it's a false premise. It's a bit like when the Bank of England got to 12% interest rates when they were on the verge of Stan Druckenmiller and George Soros like knocking them out of the exchange rate system. They went to 12, and Stan and George are like, You're bluffing. You got nothing. You can't stay at 12% rates. Like the hours are clocking away from you. You're going to destroy your economy. And like the next morning they woke up and like, yeah, you're right. Currency's moved. So there is a so domestically, the Fed should not be cutting interest rates. And they keep having to maybe later in the year. Yeah, maybe later in the year. But the suggestion, the Europeans need to cut interest rates. UK needs to cut interest rates. Japan needs to stop its currency weakening. And you can imagine a kind of Plaza Accord thing where treasury ministers get together and they all say, look, we're all going to intervene. We're going to bring the dollar down. The Fed's going to cut interest rates, not because it needs to, but because it has to help us. So if that happened, equity markets and gold and Bitcoin, they would explode in the manner that you saw in that 18-month period that led up to the March 2000 high in NASDAQ. That's a real and present danger. We saw that in 1928, and like people are like, who cares? It's like 100 years ago. But the UK was, the currency was fixed to gold at the wrong rate. It was overvalued. And the UK had to pay 4% for foreign speculators to be willing to take the risk of a devaluation. It's funny how the rates are all kind of similar, right? Yeah. But you had mass unemployment with these interest rates. And so the Bank of England went to the New York Federal Reserve and they pleaded with them, like, if you could cut interest rates, we could cut interest rates, and then we can maybe survive. And that's when Benjamin Strong, he agreed. He says, like a coupe, you take a coupe de champagne, like a coupe is like a champagne cup, a coupe de whiskey. And they put the flame, the sent stocks to the level where they were fragile, and they corrected. Okay,
so you said it's a present danger, like that assets, like stocks could explode. Help me understand that. Why would the movement go in that direction? And why would that be interpreted as like a dangerous thing?
Okay. So first of all, okay. What did I say to you? I said that I'm drawn to, I said to you, I'm a world-class loser. And I said to you that owing to that, I was drawn to scenarios and payouts where the expectation is I am for sure wrong. I'm a fantasist. Okay. But if I'm right, my return is
like convexity.
Is epic. I like epic convexity. Okay. And so I'm fantasizing because I'm the future. Like you don't see tomorrow. You have to fantasize about tomorrow. So I'm a fantasist. Okay. And again, I've been around long enough to know that whatever's happening in the yen is profound. And I also know that with interest rates at these levels, so the Fed never cuts interest rates because it got it right. It never goes, there you go.
Victory, we cut. Yeah.
It never does.
If they cut, we have a big problem, I suppose.
They cut because something breaks. Yeah. And then they cut. So I can conceive of something breaking in the financial community and with like sovereign credit and exchange rates. And equities actually take a slide. You know, we had, I think, like a 4.5% drawdown recently, and it felt like 20%. Mm-hmm. It felt like 20 because for the last year, the biggest drawdown was 2 in terms of the S&P. You know? What if the S&P slides 25% because something's gone off? And what if the Fed cuts interest rates into that scenario? So for me, like any equity allocation, indeed, my allocations into Bitcoin and gold, they're really less optimal than I want them to be. And I'm fantasizing, I'm speculating that this might happen. And if it happens, again, I'm rehearsing it, I know what I would do. I'd come in and I'd be buying. Okay, because my expectation is the Fed would then cut. Now, prices would explode because the Fed would be subjugating the domestic. It would be saying, you know what, we shouldn't be cutting. We are cutting, and therefore we're taking an inflationary risk. And therefore capital will come into alternative asset spaces. They'll come into real assets. And there's a big issue. What do you buy if money dies? And we might be at the advent of the death of money, of this form of money. And you probably buy stable, private, cash generative businesses. Yeah, I'm going to interview this drug company. I'm thinking about making myself the face of. I'm going to give them a plug now. I'm like, just why not? 1906 and 1908, the year when the outlawed cannabis, and you've now got. When Elon was king, I know he's still kind of, but he's kind of like the Sun King and he's melting a bit. But the rise and rise and rise was his genius. But what was his secret weapon? He had government love. He had subsidy. The government wanted the EV thing to happen. It was pro-public choice. And again, it's another lesson when you're looking for stocks and asset allocations. Find something where the government wants it to succeed. Yeah. And governments are mishon because they've decided now that they don't know so much, and Tesla's got. I mean, I think Tesla's gone, but I'm not investing in it. But just my fantastic narratives. Anyway, we're not talking about Tesla.
You're talking about what happens when money dies.
What happens when money dies? So, and there's a lot of money in arable farmland. I mean, that's definitely caught a bit. And you've got your gold and your Bitcoin, your diamonds, but what do you do with them? And if money's dying, actually having a business that generates. So the first thing you do actually is you'd have a lot of debt. I've always worked that way. I've got 9, I was going to say 9 billion. It feels like 9 billion. I've got 9 million euros. And it's 20-year priced at 2%, right? If money dies, that 9 million is actually a gift to me from the shareholders of the bank, because at the end, it will not be worth 9 million. The money, if money dies, it'll be worth like 90 cents. So the 9 million in value will have been transferred to me as being the borrower. So the next stage in all of this is trying to conceive, and like the commercial property blow out, whatever here. Why aren't we all property developers? Like you buy downtown property, you buy it with other people's money. You put like 40% in, you borrow 60 from the bank, you take a bullet loan, so you don't amortize it, you just pay the interest. The interest for the last 15 years has been nothing. Mm-hmm. You get to the end, the property's not worth anything. You're like, oh, and you hand the keys. And then you go back to the bank, you get more money, you go back to the bank, and you offer to buy it from the bank at like 20 cents on the dollar. I mean, welcome, Mr. Trump kind of thing. But
Crazy. So just to wrap up here, though, when we talk about the economy, I also heard you at the beginning talk a bit about a bifurcation. And I wonder too, like, we've talked about a silent depression. I'm going to like bring up my generation. Please. I feel like millennials, it's like we're in that time of our lives where we want to like go buy a house, and it's definitely not as affordable as a lot of other generations had it. So like, how do you kind of think about, is there like a haves and a have not kind of economy? Because if you're the asset holders, great, it's wonderful. But I imagine there might be many that don't feel that way, and they're struggling with a high inflation and all of that.
They are the victims. Them and Chinese citizens are the victims of the Chinese Communist Party. Forgive me, I'm down on the Chinese Communist Party, but the system that we developed is a system which created huge amounts of fantasia liquidity, which bid up asset prices. And we're kind of stuck with it just now because the gatekeepers are Wall Street, and there's a solution to it. But the solution is not asset price friendly. And so no one's like their turkeys, they're not voting for Thanksgiving or whatever. It may still happen. It may actually be, the decision may be wrestled from them. So this is the hard thing for your generation. You should have a lot of money in Bobby Digital, in Bitcoin.
That's why I think millennials like Bitcoin and younger generations. Yeah,
because they got no choice.
I have Bitcoin. I like Bitcoin.
Yeah, absolutely. It's the one prominent asset class that could be trading 3, 4, 5 times higher. Okay, and so you should have. So tech. Wow. Okay, we got it. Okay, it's not that easy, right? We're at a point in time where maybe, right, like volatility, you're short volatility when you buy all these things. It's risk, and it could explode against you. So what if you put your maximum position? And what if you did that? It's all like, what if, right? But what if it has a drawdown of 45%, right? So the hodler's like, I don't care. Well, you know what? The hodler guys, they bought really, really, or girls, they bought really, really early, and they're massively in profit, right? But if you're new, like you try sitting on like 45, 50% drawdown, you're going to puke it. You are going to puke it. So come with me, right? Let me be your guide and guardian. And I'm saying, be in it, okay? But I dare you not to be fully in it. And watch and listen to me, because if I'm right, if my fantasy is right, there'll be a friggin' amazing opportunity. And I'll be like, you don't own enough. More, buy more, buy more, buy more. You can't, but the whole thing of just, I've seen the future, you know, and you own it. You remember, again, let's do the best parable, you know, Jesus in the garden of Gethsemane, whatever. The centurion is about to come and drag him away. And he says to the disciples, you know, bad rain's coming, bad rain's coming. And you're going to deny you know me. And then I'm like, you're God, like you're Bitcoin, like you're going up 10 times. There's no way I'm forsaking you. And he's like, shh, you're going to forsake me. Like the cock will crow and you will have forsaken me. It's like, impossible. And of course we know what happens. They reject Christ. Like, man, imagine God was your buddy, but fear, the journey, right? So all I'm saying is, you should be in Bitcoin, but wait until the cock crows and then buy more.
I have to say, Hugh, thank you so much for taking us on this Acid Capitalist trip today. Can you just take the final few moments for any parting thoughts before I let you go? Anything that you want to bring up or emphasize? Apologies for the incoherence. Forgive me, there's just so much in my mind. Oh, no, people love it. They don't complain on this channel.
But we didn't talk about the girls and life and stuff like that.
Oh, or the Bono story.
Oh, the Bono story.
Yeah, we'll end on the Bono story. How about that?
Oh, yeah, let's do the Bono story. So I've really got to start making money because I've moved my office from a coffee shop to Eden Rock in St. Bart's, and it's astonishing. And I was on my computer, which is kind of bad karma in a holiday place, but you know. And you've got peripheral vision, and I can see this really hot blonde lady, and I'm like, incoming. Like, I'm like, there's someone behind me. She's passing by, but no, she stops. I'm like, hi, you know, and she's like, and she's nervous and like fidgeting, and she's like, I'm really sorry to interrupt. I'm like, I'm done with it. And so she's like, we've met before. We met 4 years ago in the south of France. And I said, Barry, I'm like, honey, I'm rapidly losing brain cells, but if I had met someone as hot as you, I would definitely remember. And she's like, no. Like, you took your notebook out and you sketched like a sunflower. And you tore it out and you gave it to me. It's my most precious possession. I'm like, all right, if you say so. I don't want to rain on your parade. And then she's like, you must meet lots of people. I'm like, well, not many. It's a true story. And so she says, hey, do you mind, like, my girlfriend Tiffany, could she take a picture of us? I'm like, fine, let's do it. I'm like, I'm not that guy.
Did you pick up on who she thought you were?
I kind of knew. But this was such a strange one. And she goes, I'm like, well, like in another, like, I'll see you in 4 years' time in the south of France. And like literally half an hour later, this middle-aged kind of, probably my age, but like my parents, the guy comes out, I was like, again, I'm really sorry, but any chance I could take a picture of you and the wife? I'm like, this is now frankly becoming 4 standard deviation weird. And then there was a big group of girls, and then they came over and they said, hey, listen, we've got a bet with our husbands. We know who you are. I'm like, I'm not that person. But they thought I was Bono.
There you go.
And our husbands are like, your husband's a smart man. And I was like, anyway, have you seen Bono? Like, Bono, I think is about 65 and going blind and bald, and he's a great guy.
He's got an Irish accent, not a Scottish accent. So there you go. And people get confused.
They can't make that distinction. Yeah. But then these girls were like, they're like, oh no. And like, oh no, he's got the same wrinkles. I was like, lady, that is out of order. And they were persuaded eventually, because I didn't have my ear pierced. So I think after this, I'm thinking about getting a tattoo, and I might get my ear pierced.
There you go. Well, Hugh Hendry, the Acid Capitalist, thank you so much for taking the time to join me today. I really appreciate it.
Thank you, Julia.